Good morning, and thank you for joining us for our In Perspective webinar with me, Kelly Durries. Joining me today, I have our Chief Investment Officer and respective investment team heads. As always, please feel free to post your questions throughout the webinar so we can address them at the end. Today, we'll unpack the expectations of 2025. But before we do so, Basti, could you briefly recap the defining macroeconomic and market developments of 2024, which trends such as shifts in monetary policy, global trade dynamics, or corporate earnings do you consider most significant, and how has that shaped your perspective for the coming year?
Sure, Kelly, thank you, and thanks everyone for joining. So I guess if we look back into 2024, the most defining theme most likely has been that we had a very steady US growth development, so GDP kept that ticking along quite nicely. We've been saying that for quite a while now, I think more than 4.5 years, basically post the great pandemic, that we said there's no recession around the corner, there's no hard or soft landing, the US economy keeps on kicking along, and that's exactly what materialized. Just to be clear, it's not that we have developed the crystal ball to make these forecasts, but we use our in-house nowcasting tools, the Prescient economic indicator, and the Prescient economic indicator basically never dipped below the zero line, indicating that there is a recession. So with that, our forecast has been consistent with that for no negative growth print, and that has played out quite nicely. On the inflation front, positive picture as well. We've been, over the last couple of years, been expecting downside surprises on inflation. I guess we got it wrong in 2022 when we peaked at 9.1, which was at a higher level than what we anticipated. Having said that, since then we've mostly been right, anticipating lower inflation prints. That is mostly based on the decomposition of inflation. So inflation, the makeup of inflation has been very limited to one or two factors since then. And also, like if you derive market implied inflation expectations, like inflation swaps have hinted consistently that inflation would come down. All of that has played out. So left us in a state with decent US growth and downward trends in inflation. So where does it lead to when we look into monetary policy? You end up in a state where the Fed could cut interest rates because growth is decent, but doesn't have to cut interest rates because inflation was in check. And I guess that's exactly what we have observed. And what did all of that mean for asset class returns? Well, last year we had a great year then for equities, be it locally, be it globally, on the back of this steady economic growth which we've experienced. We had strong returns also in the property sector across asset classes, be it locally, be it globally, be it in the commercial sector or the residential sector. And if we look into fixed income, we had a mixed picture with strong returns locally for our bond market, definitely as a more risk-on asset class, benefited in that environment. Also credit performed very well. Conway is going to speak to that, but locally and globally, strong performance on credit. The only asset class which didn't really perform that strong is obviously then global government bonds, which are normally traditionally seen as a haven asset, and there's little demand for those assets in an environment as we've seen it in 2024. So with that, throughout strong asset class returns, and the question now is, I guess, where to from here?
So, Riza, Basti actually mentioned the South African bonds having actually an incredible year for 2024, and several catalysts have been positioned for that stellar run. From local developments such as your local political outcomes, maintaining stable credit ratings, to the global economic context. Could you unpack that a little bit more for us, please?
Sure, thanks, and welcome to all our viewers. It's always a pleasure to be able to share some of our insights. So I think you're descriptive for the South African bond market as having a stellar run. I think that's quite fitting, and in fact it's a multi-year high for the bond market, and in fact South Africa was the best emerging market bond market last year. If you look at its common emerging market peers, whether you strike that returns in local currency or hard currency, we still come out as number one, right? So to sort of unpack that a little bit, I mean, we have gone several times. Those that follow these webinars closely, those that follow some of our writings in the published media will know that we very often assert that the drivers of the South African bond market are almost exclusively global in nature, right? So if we accept that as a starting point, then it stands to reason that because they had such a stellar year last year, there must have been something, some catalyst in the global environment that effectively sparked this great run, right? And I'd like to almost discuss two of them, and in some sense it builds on the fantastic bedrock that Basti has laid for us from the global macro backdrop. So the first one, relates to what is commonly called the backbone of global aggregate demand, which is the U.S. consumer and U.S. household. So the big catalyst there was essentially that the U.S. economy has proved to be quite resilient in the face of consensus expectations that had been priced for recession. In other words, it had been priced for recession, and then the delta around that was quite positive for risk assets, right? And just to give a little bit of detail, I mean, there are several indicators. Basti mentioned one of them, but there are several indicators that we had quite early at our disposal that indicated, that led to us actually attaching quite low probability to actually that recession materializing. One of them was the fact that we know that typically econometric evidence suggests that a recession normally follows around 3 to 6 months after the last hike, right? So if anything, there would have been a recession around December 2023, given that the last hike was around July of 2023. That did not happen, so that was clue number one. Clue number two was the fact that you had, generally speaking, when you find a US recession, you find that there's usually a very big build-up in household leverage. In other words, consumers start taking on more and more debt, and then the hiking cycle typically means that they can't service that debt anymore and consumption falls off a cliff. The consumption in the post-pandemic period was largely funded by fiscal transfers, not because of a build-up of household leverage. So that was clue number two, indicating why there would not be a recession. And the final one is essentially the fact that we saw unemployment ticking up, ever so slightly, but that was largely on account of not that people are being laid off, but simply that the labor market was actually increasing. The size of the labor force was increasing. So you take those three clues, you put it into a pot, you combine that with our Prescient economic indicator, and you've got a strong idea that there would actually be a low probability that you would have a recession. Now, what happens in that when that delta actually happens, when that penny actually dropped for the rest of the market and consensus expectations had to be inverted in some sense, that was massively positive for risk assets. That was catalyst number one. Catalyst number two was, again, building on what Basti said, you had this continued impulse with disinflation. So you then had continued impulse with disinflation that fed through to the expectation that financial conditions would ease because the Fed could now afford to loosen policy rates. So disinflation, the expectation that there would be easing financial conditions, and a strong bedrock for consumption globally. You put those two together in a melting pot, and it was off to the races for South African bonds. The unfortunate thing, and maybe just ending with this, is that this sort of happened at the same time that you had local political reconfiguration. So a lot of commentators and journalists, financial journalists, connected the dots to almost suggest that no, it's because of these political developments that we are now seeing, and we disagree with that for the reasons that I've outlined. We think that those two catalysts alone explain, most of the run that we saw in South African bond market.
Thanks, Riza. So, Henk, I think taking from what Basti and Riza have just spoken about and focusing on the Fed and the SARB, how did the 24 end for the income funds, with front-end yields arguably being a bit higher than expected?
Yeah, thanks, Kelly. Great question, and thanks for Basti and Riza for setting the scene. So arguably, what we saw, the expectations for quite a lot of decreases in interest rates, so a lot of cuts priced specifically on the Fed side, but also somewhat in the local side. We saw some of those cuts come through, both in the US and in SA, but now the expectation for further reductions in rates, based on what Basti and Riza has already told us, with the growth story in the US kicking on, really a recession not around the corner. Inflation, yes, will give them the opportunity to cut, but they don't really have to. So they've paid back that expectation. So if we think back to, let's say, start of Q4 last year, the market was expecting about 10 cuts in the US. So that's 10, 25 basis points cut to the end of this year. Okay, we saw 4, so we had the 50 bips and then 225. So take 4 out of that equation, we should be left with 6 cuts. The market is now expecting less than 2. Okay, so quite a strong payback of what we were seeing as front-end rate being a lot lower than where they arguably can be now. And that, yes, that's for a personal consumer with some debt, it's not a great story. But for us, managing the front end of our yield curve, for investors earning interest, certainly still a great story. So funds did really well last year, ended the year quite strongly. inflation plus sort of returns keeps going, and with the elevated nature still, we still see quite a lot of opportunity. So yes, not a great story from a personal perspective, but still the Goldilocks story for income and front end continues.
Definitely. I think, so just to round up that reflection of 2024, what were the key drivers did you see in the local equity market? Which sectors or market segments stood out, either positively or negatively, and which economic or geopolitical factors influence those?
Yeah, okay. Thanks, Kelly, and thanks to our viewers for tuning in. So looking at local equity markets in 2024, despite sort of ending on solid ground, it was actually quite a bit of a roller coaster ride. If we think back going into 2024, we had obviously what's been mentioned around inflation and sort of rate uncertainty, but we also had the economic backdrop of slowing growth concerns. I think the economy was still reeling from what was probably the worst load shedding bout just prior to that. And then we had this election uncertainty, which brought into question our sovereignty, essentially. That dissipated going into Q2 and Q3. We got past the election, and eventually load shedding, sort of subsided. We saw inflation coming off, and that, sparked this risk-on trade. We saw foreign capital coming into our markets, and it boosted risk assets in general. So specific sectors that we saw, property, I think Bastian mentioned it, was one of the standouts. Over the calendar year 2024, I think property did close to 30%, 30%, which is an astounding year. And I think that's on the back of, again, just the renewed, investor confidence, lower borrowing costs, increased demand, and you can sort of see that if you look at vacancy rates, particularly across sort of your office and industrial property subsectors. And then we also had banks that had a phenomenal year. I think they did about 23%, which was surprising, but a good surprise, given that lower borrowing costs typically would be expected to result in shrinking net interest margins, but banks seems to stabilize that quite nicely. And given the economic growth concerns, the risk management came through quite stellar. We saw non-performing loans pretty much stabilized. But we saw so banks did really well, but then towards the back end of the year, there was a bit of a pullback. And I think that's also more an exogenous factor, in the sense that we had, the big political event of 2024, which was the US elections, and we saw, recalibration of the pace of monetary easing, given the sort of incoming administration's policies, and, the change to global trade dynamics, expected change to global trade dynamics, which impacted some sectors negatively. If I could highlight one, probably resources. Our resources sector, I think, gave back 10% in the calendar year, and particularly the platinum miners. So really lower demand and prices for the material. This is a bunch of reasons for this, sort of the move towards a greener energy transition, the proliferation of electric vehicles, what have you, but that sector stood out. But all in all, despite the roller coaster ride, it was a stellar year for local equities. Healthy double-digit growth. I think the all-share index did something like 13.5%, well ahead of inflation and well ahead of the broader emerging markets.
Thanks, Cecil. So that was the year that was in 2024. And top of everybody's mind is what's in store for 2025? Like, what can we expect? Basti mentioned, we'd like to have a crystal ball and know exactly what's going to happen. Unfortunately, we don't. So, Basti, if you can respond to, which specific economic indicators or overarching themes will you be monitoring closely? Do you foresee any notable shifts in the global economic landscape or financial markets? and which critical indicators such as geopolitical events, consumer sentiment or inflationary pressures do you see impacting outcomes going forward?
Yeah, good point. I guess once again we will focus on global growth and global inflation, and with that monetary policy, so nothing will change there. But I do think that we have already observed quite an important change in the US yield curve, which is absolutely crucial. So if we just think back until, let's call it the beginning of December until today, where most of us were still on holidays, the US yield curve has already shifted up by like 50 basis points, especially like using the 10-year reference point now, 50 bips higher interest rates. And if we go back to after Trump got elected, 1% higher interest rates in the, I don't want to call it the risk-free rate because there's a term to it, but basically the US 10-year rate, that's massive. So that's a massive shift, and that's hinting something. So what does it hint? So we always mentioned already in the intro that our Prescient economic indicator is hinting towards steady growth in 2025. Our inflation expectations based on market expectations, but based also on the makeup of US inflation, are also hinting towards inflation which is in line with where the Fed wants to be. So you almost have this quite steady state of decent growth and limited inflationary worries. So why then must interest rates be at 4.5 or the 10-year even at 5%? And I guess that in itself tells a quite interesting story. So what we have done mostly with Riza and the bond team is we have dissected the makeup of those drivers. So what has actually driven that 10-year rate higher? And that in itself is an interesting narrative because we do think that's very, very crucial to understand in terms of what's shaping 2020-25. So what has happened is that first assumption is, why does this 10-year rate move higher? The first assumption could be it moves higher because we see higher interest rates for longer. Okay, so if you have, for example, the anticipation that inflation is going to be higher for longer, maybe based on more tariffs coming in, etc., then you should have higher interest rates based on high inflation expectations. That's absolutely not the case. So if you look into why interest rates have moved higher, it's not based on high inflation expectations. Okay, the next possible driver of higher 10-year interest rates is a rise in the inflation risk premium. So basically, you don't expect inflation to be higher, but there's a risk of inflation to be higher. So now I want to be paid more for holding these long-term bonds because they're more risky. So we can back out the inflation risk premium, again, something which could be anticipated to be higher because Trump brings tariffs, Trump brings a lot of deregulation, etc., etc. So maybe there's more inflation coming. Answer is no, that's also not the driver. So market participants don't expect inflation to be higher. Market participants are not more worried about inflation. So what is the driver then? The last building block which is then left is the expectation of a higher real term premium. So that means you want, despite not expecting more inflation, despite not being more worried about inflation, you now are in a scenario potentially where you have more productivity growth, more expectations of GDP growth, deregulation, tax cuts. All of that means that the 10-year US government bond now has to compete with that more attractive US equity market. And that's exactly what we've observed, and that's what's going to shape 2020-25. So can Trump deliver on his promises? Will he be more disruptive? Will there be geopolitical events, negative ones, positive ones? But certainly that's exactly what we will observe, and the data won't lie, so we just follow that story and we know where we're moving.
Thanks, Basti. So looking into 2025 for the equity market, which equity market segments are poised to lead growth, and what is driving that optimism? At the same time, could you just speak to the potential risks and challenges that the equity market faces, and how can our investors prepare for those?
Good question. I mean, I think going into 2025, obviously there's a lot of unknowns, but I think it would be a challenge to talk about the outlook for equity markets without thinking about big tech and AI, the theme that has driven markets higher globally in 2024. And I think if you think about the long-term economic output, expression of output as a function of growth in the labor force, growth in capital, so savings and investments, and then growth in technological advancements. I think AI is obviously a big factor. So being able to produce more using the same input amounts of labor and capital. And the market has reacted quite positively to this in 2024. And if you look at the concentration of that reaction, it's mainly been towards the enablers of AI. So your semiconductor manufacturing and design companies, your cloud computing type companies. And I think going into 2025, we're likely to see more of the same disruption across industries, but it will be at a secondary level. So now more the industries that can adopt and sort of unlock those efficiencies from AI quicker. And I think it's a tricky question to say, okay, which ones specifically are more poised to do that? But I think what it does highlight is that there's risks to this as well. So if you look at valuations, the traditional view on valuations is perhaps not as well equipped to be able to make a call on which sectors can benefit, because these sectors are valued for perfection. And the risk is obviously that the earnings expectations fall short, and that investors actually end up in the red. So how to mitigate for this? I mean, we do it in our portfolio construction. So an innovative and multi-dimensional view on risk when constructing these portfolios. So first and foremost, we separate the two sources of returns in any process. So we'll have our beta view, which is essentially diversified as possible. That again is to manage the risk and ensure that equity investors, for instance, in our emerging market funds or our developed market funds, have access to over 2,000 securities globally. So that removes the idiosyncratic risk and makes sure they benefit from the pure market performance. But then we also have a big differentiator is this uncorrelated source of alpha, which we harvest and engineer from our fixed income and our cash space. So what that allows us to do is, on top of making sure that investors get this pure exposure to equity market, regardless of what sectors do well, they also get an uncorrelated source of alpha that is much more reliable, that's harvested from the fixed income space.
So given all of these complexities that we've mentioned, Rupert, and the broad nature of multi-asset funds, how do you begin to start, bringing this all together? And are there any specific asset classes that's special to Prescient multi-asset funds?
Yeah, thanks for having us today. So I think I'm in a privileged position because I get to leverage off every team member at this table. And that's just how we run at Prescient. We run as a team-based approach. In multi-asset, we have to take the somewhat daunting task of combining assets all the way around the world, be it South Africa, global, emerging markets, across asset classes, so equities, bonds, or general fixed income, credit, property, currencies, into one product. So we try and do that by questioning what exactly the investors need. So for example, in our high equity funds, it's a CPI plus 6 long-term investment horizon for Regulation 28 pension fund investors. And then we take a top-down view and we construct those long-term portfolios. So what we'll do is we'll say, what is the maximum likelihood of achieving those investment objectives given the asset classes that we have on the table? And I'm not constrained to invest in any asset class around this table. We do, but that's a benefit that we have because we get to access those asset classes at fantastic product suites and innovative processes. So to go through the asset classes, we have equities run by the equities team. We don't pick stocks in our portfolios. We believe in top-down, passive beta exposure with fixed income alpha on top of that. So single stock picking, a very, very tough game and something that we would rather focus our time in the fixed income space. Property, the same thing. Fixed income, we have at the front end with Henk and team, towards the back end with Riza and team. That's very much active in the underlying instruments that we pick and the duration calls that are within those building blocks. And then last but not least, we've got the credit side, which I think is one of the most innovative teams at Prescient. We get access there to credit in the South African space at a very granular level. So every single issuance is rated in our Prescient credit model, which allows us to give a probability of default for every single fixed income issuance, and then the expected yield profile, the required yield profile to invest into that issuance. That, and then the last two being the infrastructure and clean energy funds, give us really great diversification differentiators as a multi-asset team compared to other multi-asset investment products in South Africa.
So you mentioned credit, and that has typically been quite topical with clients. So I think, Conway, if you can perhaps step in here and just give us an overview of the outlook for high yield credit in South Africa, and then also how do you balance the high potential returns with associated risks?
Hi, good morning everyone. So I think if you were to ask me simply what the outlook is for credit, firstly it was a roller coaster 2023 and 2024, and we're taking that into 2025. We are cautiously optimistic. So I think the starting point is the optimism part, and Riza and Basti have eloquently expressed why they are a bit more happy with what's happening out there from a growth perspective, from an economics perspective, from a global perspective. But then also optimistic in terms of the amount of opportunities that we are seeing. It is amazing to see that in a market that is as small and confined as ours, that there actually, when you're looking at credit at a granular level, that there are more than enough opportunities to fill all of the buckets across the table. Then we go to the cautious part, and I think that is where I started off with this roller coaster. If you are looking at the top corporates out there, the top 40 and the likes, you are seeing positive earnings growth and the likes, which again talks to a positive stance on either earnings and or cash that is held. But we have boots on the ground in terms of that second and third tier, where we're actually seeing restructuring of covenants, restructuring of balance sheets, and we're seeing a lot more action happening in credit than before. So that cautious part is that, again, with all of those opportunities, you have to be selective in what you choose. And I think Rupert just mentioned our default probability models that we run, the opportunities that we assess and how we assess it in a very innovative manner. We run a full systematic approach where every single ticker, whether it has a corporate issuance or not, goes through our rating model, and then we have a default probability set of about 220 different borrowers, different opportunities that we can invest in. So again, we're being very selective because we do know that, again, with credit being very topical, with credit, if there are any sort of issues, you need to have a team that manages it appropriately. So you have to be cautious in your approach, cautious in your assessment of risk. We're simply trying to protect the coupon here. We don't get the benefit of the blue sky that many of my colleagues on the table do get when earnings do shoot through the roof. We simply get our coupon. So we need to make sure that we're protecting ourselves if there are any of those pebbles along the way. So yeah, we are looking at many opportunities. We are also seeing how the opening up of economic reforms, changes to regulation is making it easier for us to invest, but also in that cautious nature is always the risk of liquidity in credit, but then over and above just I wouldn't say no liquidity, a very muted liquidity profile of credit instruments is the fact that once you are in there, you are knowing you have to be there for the life of those instruments. So again, cautious approach where team assesses all of these opportunities in minutia and does a lot of sensitivity analysis and screening to see that once we're in those opportunities, that we know what we're investing, why we're investing, and we're there for the long term.
So I think you've touched on this, but if you have anything to add about what the key trends and developments are in the credit markets that you are monitoring, and how does this influence your decision making and strategy?
So I think the first thing is that we have a corporate South Africa that is very healthy. And I'm going to say that, and it's not normally said out there in the market, but the fact of the matter is we've got on average about 20 to 25% in cash at the corporate level. That is unheard of globally. In the UK, in the developed world, it's about 8 to 10%. In our developing market peers, it's 8 to 12% of cash. We're sitting on a lot of cash. And why, for whatever reason that is, including there's no activity actually happening, that cash does give you a buffer at the top level. So we're watching very closely how corporates are actually going to re-gear. Because over the last 5 years, there's been this massive de-gearing exercise that's happening. And if there is this re-gearing or corporate activity does pick up because of the economics allowing it, we want to be there to be able to invest. At the same time, we are seeing, again, muted liquidity. So again, we have to be careful in terms of how we assess liquidity so that when Seiso, Henk, Rupert want to exit positions, that we can actually affect that. And then finally, and the most important part in terms of why credit is not the darling of the market is we have seen increased risk historically, but spreads continually operate in the opposite direction. Where we think of it a little bit different is that spread is only one component of your total return. So again, imagine 5 years ago, you had JIBAR at significantly lower where you are now, and you had a higher spread. Now you're having JIBAR at current levels with a muted spread. So we're looking at from a total return perspective. And again, with all of those opportunities out there and us seeing all of the, I suppose, noise on the street, you can understand why we're being very cautious. And we're looking at the total return, we're looking at the spread, we're looking at the opportunities to make sure that when we invest, all of the components are considered, and that we then also put diversity in our portfolios. I think diversity for us is one of our key tenets of whatever we do. And if you don't do that and there is a problem, you can actually lose all of your returns very, very quickly. So that is what we're looking at very carefully, that diversity angle in terms of across all of our funds.
So how do you then incorporate the diversification? And then what would the benefits and challenges be for that approach within credit?
So the first thing is, if you have a great opportunity and you want to invest all your money, your diversity rule excludes it. So that makes it very hard, especially when you do have certain opportunities that are yielding amazing yields, right? But we are rules-based. We've got a 4% rule across our funds, where if any asset is going to be in excess of 4%, you need CIO, you need head of credit, and also our investment committee approval for that. And again, what that has helped is where there have been credit events, we haven't felt the significant impact of a credit event. Having 10-15% of one issuer in your portfolio, and that issuer actually defaults or actually has a problem, versus a 2-3%, you can actually stomach that sort of loss. And I think we've backed out the 4% scientifically, because we know which funds require specific returns. We know how long we want to be able to actually experience that sort of credit event without being able to lose our return. So I think diversity is the core of what we do to ensure that we manage our portfolios appropriately. We include that additional buffer of safety in our funds, and that we can actually then sleep very comfortably at night.
I think this is a perfect time, Cesar, to bring you in, because we need to just unpack what the role of credit has within your portable alpha strategies. I know you touched on it earlier on in terms of uncorrelated sources of alpha, but perhaps you want to just elaborate on this a little bit more. How is credit incorporated in your process, and then how are these risks managed within your funds, and why is this the preferred approach?
Thanks, Kelly. Like as you said, we prefer this approach because it entails harvesting fixed income and cash risk premia and transporting that on top of a desired equity market beta. It doesn't have to be equities. We employ it across the floor. We have a bond portable alpha process as well. And this portfolio construction is such that when we harvest this cash and fixed income, there's two risk premia that we can get. It's either by investing in term assets, where we get paid to basically lock up our cash for longer periods of time, and or credit assets. And in the environment where we're seeing fewer and fewer cuts being priced in, it actually, the term premium is less attractive, and therefore we're relying more and more on to the credit premium to generate outperformance. And in addition to outsourcing all of the sort of credit decisions to Conway and his team, therefore leveraging off of all the work and the expertise that they do, we also construct our portfolios in such a way that we take a holistic view on the risk on the equity portfolio. That is monitoring variables like expected shortfall, which is essentially a conditional VAR or value at risk measure to say when we do underperform, let's say our funding, what is the average underperformance that we can see, and optimization will take that into account and try and minimize that. We also have traditional volatility metrics such as tracking error to say what is the absolute volatility of our alpha engine, cash and fixed income alpha engine. And because we're doing this, we have a truly diversified portfolio, not just from a beta perspective, but also across asset classes, but within one product. Why is this the preferred approach? It is preferred because it is a much more reliable source of outperformance compared to your traditional stock picking, as Rupert mentioned. It is a much more forgiving source of outperformance. So stock picking, when it goes wrong, it can go really, really wrong, whereas the cash and fixed income space, much more forgiving and much more reliable to harvest these risk premia. And the final reason we love this is that it comes at a fraction of the cost, which of course is passed on directly to to our clients. So our TICs are really, really low, and because of that, we have less of a headwind in terms of performance pickup, and that can be seen in our products and the performance that we've been able to achieve.
Thanks, Iso. So let's just zoom back out a little bit and look a little bit more globally. Riza, in some of your earlier comments, barring geopolitical curveballs, the US economy is sort of a Goldilocks economic position with resilient consumption-led growth, steady labor market, and gradual inflation. I mean, estimates for real-time trend growth is just below 2%. Why then, with a promising economic backdrop and in the world's biggest economy as the US, do we find that South African bond yields sometimes sell off when we receive real economic data coming out of the US, positive real economic data?
It's a great question. I think the best way to tackle that is to make use of a very popular workhorse in macroeconomics, which is known as the Phillips curve. And what it really says in simple terms is that you're really trading off unemployment in the original iteration. You're trading off unemployment against wage growth. So as it goes, the tighter labor markets go in the expansion phase of an economy, the more tight the labor market is. Let's say unemployment is like capacity utilization very high, the unemployment quite low, you have high wage growth. That makes sense because as employers are now looking for more labor, they're willing to pay up a little bit more. So the wage versus unemployment version of the Phillips curve, that's alive and well, right? Then a generalization of that was basically to say, okay, I'm gonna now not plot unemployment against wage growth, I'm gonna plot unemployment against inflation, right? And originally for about the first decade of its operation, that was also alive and well. But in the past 2 decades, the relationship between a tight labor market and realized inflation has broken down completely, right? So it's actually now quite spurious. It does not follow that if you have a tight labor market, you will have realized inflation in the same way that it follows that if you have a tight labor market, you'll have wage growth. So what markets are doing is effectively believing that the second version of the Phillips curve is still alive and kicking. So they're arguing as follows. They're basically saying, if the US economy is robust, I will have a tight labor market, therefore I will have wage growth, therefore I will have inflation, therefore the Fed will start hiking again, and therefore I will have tight financial conditions. Now, of course, it's not going to work like that because the evidence simply doesn't support it. You may very well have wage growth, but there's no empirical data to support the notion that even with wage growth now, you will have inflation. So it's a little bit part of that kind of storyboard that sometimes you see despite and a Goldilocks type of backdrop, that you don't in fact necessarily have to have inflation, and markets are getting a little bit ahead of themselves in assuming that financial conditions will retighten.
So it's always interesting having a look at the global playing field, and I think that's what's interesting for you now, Henk. From a local yield perspective, it was higher than previously thought, and now also on the global side, the global yield's also attractive. So what do you look for in the global space in terms of attractiveness?
Absolutely, great question, Kelly, thank you. Rupert made some comments around global asset classes. There was a lot of talk about diversification, etc. If you focus into the global yield complex and the opportunity set that we see, if we focus on a product like the global income provider as an example, one needs to think about how to put a portfolio together using all these different asset classes. So you can think about the front end of the US yield curve, back end of the US yield curve. We mentioned 10-year rates being 1% higher. There's corporate activity, there's emerging markets, there's emerging market corporates, etc. So there's a lot of different opportunities that we can think about when allocating into the global fixed income space and the global income space specifically. So how do we then build a portfolio in that space? We follow our systematic approach. So for us, we trade off 2 things. One, expected return. That's important. It's not just the expected yield, but the return. So we have a view when it comes to different asset classes. And 2, the risk that brings to a portfolio. On the global income side of things, when you think about risk, it's all about rolling return expectations of not losing money over, say, 12 months. And on the return side, then it's a real return target of US CPI plus 1. What is interesting and what we are seeing, given all the dynamics and all the movements we've seen in the global yield space, it is still most optimal to be focused on the front end. So very front end of the US rate, still very elevated. So 3-month US deposits, some of the South African offshore bonds, the SOF bonds, front end looking very attractive. And then when you can add some risk, it's thinking about floating rate exposure. So buy some yield opportunity, but don't fix it. So buy floating rate. And that's interesting given the fact that we've seen this move in the term premium or the 10-year yield going 1% higher, one would expect to see, there might be some value there now. But certainly from our perspective, looking at this yield curve, maybe not just yet. You still want to be focused on the front end. You still want to focus on floating. Global yield credit spreads are very tight. Even high yield, if you look at the indices, etc. So the opportunity for us remains elevated front end, very riskless, if you can use that word. But the opportunity exists, and for investors looking for opportunities offshore, yield is definitely still one of them.
So we've spoken about diversification and the risk management thereof. We've spoken about local and global opportunities. We even touched on high yield credit. One thing that we haven't gone into a little bit more detail about is alternatives. I think Rupert mentioned it a little bit earlier, but Conway, let's chat about, Prescient clean energy and infrastructure debt funds. How do you see the role of infrastructure and clean energy investing evolving, and what are the key drivers and risks associated with investing in these assets in 2025?
So I think I spoke about all of the opportunity sets that we are seeing. So it's actually been a very eventful end of 2024 and the beginning of 2025 with the various bid windows announced. And also this mega infrastructure bid window that's also happening. So there's a lot of opportunities in that space. I think what the fiscus has realized is that without infrastructure and working infrastructure, everything else is going to fall apart. We're not going to have the ability to come to work. We're not going to have electricity. We're not going to have all of those things that actually facilitate us doing our jobs. So I think with that being said, the opportunity set is, again, as I mentioned earlier, we are very optimistic about. Again, lots of opportunities. Now we go into the risk part of it, right? If you don't know what you're doing, you are going to get burnt. So with these opportunities, you need to be able to structure it. You need to be able to consider it. You need to analyze it appropriately. And you need to have a team that does all of that. But the exciting part about doing that is just the execution of it. Where you make and lose money is actually the monitoring thereof. And I think one thing that I alluded to is that having boots on the ground, we've seen quite a bit of stresses when it comes to borrowers. So again, you need a team that can not only execute on opportunities, but that can monitor those opportunities. Constantly be chatting to management teams, updating your forecasts, considering the assumptions relating to up to a 20-year type deal. And I think some people will say it's crazy, you can't do that. But again, very different than the equity side in that we have a contractual stream of cash flows that come from all of these projects, and we're assessing the ability of those borrowers to actually repay us. So again, lots and lots of opportunities out there, including what is happening at Eskom, the positives that are happening at Transnet. And again, that seems like an oxymoron, like positives on Eskom side, positives on Transnet side. But the reality is that the private sector and the public sector is working closely so that we can get our key infrastructure players up and running and in a better position than we were. We shouldn't have been in this place or this position that we are. But again, that's the past. Looking forward, we need to fix our rail. We need to fix our ports. Certain of our ports are considered the worst in the world. We need to make sure that we continue not having load shedding so that we can actually have manufacturing entities come out and play. So I think we are positive on infrastructure, as is government. And again, that public-private partnership that is happening to improve the infrastructure ecosystem is probably why we are as optimistic as we are. Yet, you have to be careful in your selection of those assets. You can't simply go do a water deal and then there's a change in policy and things change. So you have to understand the risks, understand who you're dealing with. And again, these are highly bespoke, to an extent, highly risky investments. Even if you have a government guarantee, you don't necessarily just want to rely on it. But these investments are highly structured and you need to know how you project finance it, how you deal with the actual technicalities behind these opportunities. And that is where that risk component is what we place at the heart of everything we do. And then we do that systematically. We've built our models to assess these different type of risks and also have experience around the table of about more than 200 years of what we're doing. So it's a place, again, to reiterate that cautious optimism that we are showing. But again, if we get infrastructure right, we get the equity markets to work, we get the bonds to actually do what they're supposed to be doing with the bond space to work accordingly. And then we've got Rupert that can invest in ours, as he mentioned, at a very, very decent fee, as you'd say. Yeah.
Thanks, Conway. So Rupert invests in yours, but it's also on insight in terms of Prescient income provider. You're putting together the credit funds as well as the bonds within that portfolio. Could you give us a bit of an outlook for the year ahead for the income funds? What can clients expect in the year ahead?
Yeah, so 2024, just to quickly look back, 11.7%, that's almost inflation plus 9. So that's certainly not what we're targeting. CPI plus 3 is our target, so very much Goldilocks last year. Looking forward, do we expect something similar? Well, forward yield in the fund about 10.1%, still very healthy. Inflation expectations over the next year around 4%, so CPI plus 6 are still very, very elevated real expectations or real return expectations. So we're very optimistic. But I think what's very important to understand when it comes to a product like the Income Provider Fund, with all these uncertainties, all the things we've talked about, we'll go about putting that portfolio together with our risk mindset first and foremost, right? So we've got a risk target of not losing money over a 3-month period. And in markets like that we've seen last year and potentially what we can see this year, having that sleep easy capital preservation mindset allows us, one, to get to our return target, but put our clients on a journey that's relevant for their risk appetite, and that's very important when it comes to the income space specifically.
Well, it sounds very promising for the income funds. Rupert, on your side, based on your current forecasts, which asset classes appear to offer some strong risk-adjusted returns? Are there any heightened vulnerabilities or less attractive prospects? And then how do considerations like valuations, economics, financial conditions and sentiment, tailwinds and headwinds inform that view of yours?
I think Henk introed that quite well. In the income space, we are starting with roughly a 10% yield in an inflationary environment, which is actually relatively low. And then extend that with a bit more duration, you're getting above 11% in the bond space, again, an inflationary environment which is relatively low in South Africa. In the offshore markets, we're looking at, let's say, 5% and above in Global Income Fund, in an environment when hopefully inflation continues to come down. In the credit space, we're getting 13% or thereabouts when inflation is pretty low. In the equity space, backed by fixed income, we're getting a reasonably attractive SA equity market. So sitting where I'm sitting right now, as the head of multi-asset, it's a great place to be. It's not all Goldilocks though, it never is, and that's why we try and diversify across asset classes. We don't think that there is a massive headwind, let's call it that, towards US equities. But there certainly is the possibility that that headwind starts to emerge. And why am I talking about that? So Bastian covered the Prescient economic indicator. We've monitored in real time that the economic growth outlook in real terms for the United States wasn't going to go negative. We still think that it's positive. We still think that it's around or just below trend growth. We track that on a daily basis. But the issue with that is that you've got US equities sitting on a 28 times PE ratio. So you've got a lot of this driven by big tech, AI investments in the United States, which is a fair point. They've had massive growth trajectories, but we're starting to see competitors from the likes of China coming to undercut those margins in the United States. So there certainly is a risk towards a strong bull run continuing for the next 5 years in US equities. We're currently neutral on US equities though, and that's because we see a reasonably solid growth outlook despite the valuations. And we see quite a strong sentiment. So with the likes of Donald Trump taking on his second term as president, sentiment has picked up, and a growth trajectory sentiment, which has buoyed up the market expectations. So that's the other side of the coin. You mentioned that we look at things through different lenses. Again, always systematic. So instead of necessarily investing in AI, we're investing with AI or big data. And what we use is valuations, so valuations being how cheap or expensive different asset classes are. Economics, which is the underlying assumptions on growth within those asset classes, differs around the world. Financial conditions, so how easy is it to access capital, to keep the cogs turning in financial markets. And the last one, sentiment. And I always focus on this one. And I say you can have a very, very expensive equity market, so valuations very poor. You can have mediocre growth expectations. You can have financial conditions which aren't necessarily improving, but very positive sentiment, and that can move markets higher. So we focus on all of those lenses, and all of us across this table focus on our investment decisions in exactly the same way. And that allows us to bulk up those investment decisions into a multi-asset view, which at the moment, as I said, I started this chat is saying that it's quite positive, but the key is that we monitor these things in real time. So things can change, and if things do change, we trade in highly liquid instruments, and we can change the asset allocations within our global balance funds all around the world. So it's a great place to be, especially going into a year of relative uncertainty in 2025. Not the year of 2024 that had a record number of national elections, but what we've now got as a result of those national elections is uncertainty around government policy around the world. And that's something that you can't really predict. So that's how we position ourselves.
Thanks, Rupert. But yeah, I think to just close us off, Rupert touched on it now in terms of key risks to our outlook. With Trump now in office, we can't ignore that. How do you anticipate his agenda in areas such as trade, tax, or regulatory reform to impact economic and market dynamics in 2025? How do we, like Rupert mentioned, everything's systematic, or everybody mentioned that I think this morning. How do we incorporate that into our analytical framework? And then, just are there any other imminent geopolitical risks that may materially impact our outlook?
Yeah, so first of all, I want to say that exactly as Rupert said, there's many ways to be worried about the future in a way that the outlook starts very positive, but then we do know that things change. So how do we pick that up systematically if there's change in politics, if there's change in Conway mentioned load shedding earlier, and if just the political environment changes, all of that. We can pick all of that up systematically by basically quantifying qualitative data, and that's quite possible. For example, we use structured surveys around consumer confidence, structured surveys around business confidence. Business confidence immediately ticks up if there's load shedding, immediately plummets if there's other way around, picks up if there's no load shedding, immediately plummets if there is load shedding again. Same story for investor confidence, which immediately crashes if there's a new virus detected or if there's a pandemic on the rise. So it's a lot of soft data that if you eliminate human biases around that and quantify it properly, which can actually give you clues. And we use all of that. We create our own surveys. We create alternative data, which delves into sentiment to basically be on the pulse of these events like geopolitics or politics in general. So that works pretty well. I guess for the year ahead and a little bit of an outlook, we spoke a lot about the steady state economy, inflation where it should be, growth where it should be, no clear indication of no red flags, so to say. So what's going to deviate us from that journey, we don't know, but we're certainly going to keep our eyes open. The data will tell us in time. The assumption right now is quite positive on Trump's policies, like everything is priced to perfection to some degree, that there's a lot of positives coming from that, like deregulation, lower taxes, all of that is good for growth. But then what will the reality really hold? So that's what we will have to observe, and the data will go quickly with that. I mentioned consumer confidence, I mentioned business confidence. Those will turn quickly if Trump doesn't pull through on the promises which he makes. So just summing up all the outlook, I mean, again, quoting Rupert, what he said earlier, that you can't be super bearish on US equities or global equities, global risk assets, because yes, they are priced for perfection, but there's a lot of supportive factors. I mentioned the economic picture, monetary policy to potentially eventually ease, and then also sentiment being still positive. So a lot of positives around that. And then a lot of SA assets also being priced quite positively. Like, for example, start with the cash and income space. Henk mentioned CPI plus 9 last year, but still CPI plus 6 or 7 almost the outlook for this year. Links also into credit, the front end of the curve in generally very attractively priced. For the bond space, also in the South African space, not so much in the global space, South African space very positive, because we still have yields at 11.5. If you bake in the roll down, you're at like 12, 12.5. If you consider that we expect some curve compression, you're at 13, and add a percent of portable alpha, you're at 14. And that's an environment where inflation is going to be 4%. So it's very attractive. And then last but not least, the equity market. I mean, CSM team have proven that they can add a little bit on top of the equity beta every year in a very consistent, reliable way. So we'll just keep on doing that. And at the same point in time, SA equities, one of the few asset classes in the equity space which are still incredibly cheap. So all these positive scenarios playing out, then that should be one of the asset classes which experience most of the gains. So a lot of positive things to look forward to, yet we do take a balanced stance because there are risks. there's always risks, and I guess geopolitics obviously will be most likely the biggest one yet, and it doesn't have to be a new war, it doesn't have to be a pandemic or a financial crisis, but it could just be a deviation from Trump's promises, and that would be a big risk.
Thanks, Basti, and thanks, guys, for joining me this morning. I think we've given clients quite a bit to think about it and to digest. I think what is clear that with our systematic approach, we really aim to consider it all for our clients to give them the competitive advantage, and I think we've really unpacked that today. So to everyone watching, thank you for joining us, and we look forward to addressing your questions.
Good morning, and thank you so much for your questions. We received quite a few this morning, so we'll try our best to address as many as possible in the time we have left. If we don't get to it, please know that we will respond to it by email after the session. So getting straight into it, and no surprise that this has been the topic for this morning. There are quite a few on this, so hopefully we can address just this one question. This morning there are rumors of Donald Trump cutting funding to South Africa and restricting trade on the back of passing the land expropriation bill. With you running a purely systematic process, how could a change in US policy under Donald Trump be reflected in your models? How do you react to news like what we hear this morning?
Yeah, thanks, Kelly. Good question. I guess always when short-term volatility spikes, we immediately get these questions like, how do you react over the short term? I guess the trick is to understand, first of all, the news into detail. We use a lot of factors which are helping us to understand what that news flow means for the economy, for the SA economy, the US economy, and with that for our asset classes. But just some examples how we capture this. We look into surveys like consumer confidence, business confidence. They will heavily be impacted if Donald Trump follows through on what he says. It's too early to say that yet. Also, those surveys are slightly slower moving. We do use financial conditions indicators, like how many cuts are there priced, how tight are credit spreads, how easy is it to get funding, are there cross-currency basis, so it's the financial system somehow impacted. All of that we will also pick up, and those are very fast-moving indicators. Those are reacting already this morning, although not in a big way, but they will react on the moment where news like this spreads. And then last but not least, we also look into implied volatility to understand market sentiment, and we can back out how much uncertainty there is priced already. Is the market in a panic mode already or not? So all of that basically gives us a pretty clear picture on where we're at. And I just want to highlight that this is, in our opinion, the way to deal with these news. Like, don't just issue your own opinion on top and try to sound smart, but rather cut through the noise, use a systematic approach, use all of these indicators which drive markets, and that's where we assess the information. And the nice thing is we've done that already because our indicators have reacted, and with that, our stance could potentially change this morning already.
So that leads to the next question. I was asked, what will the impact of this be on the short and medium term?
Yeah, so that's too early to say, but I will just reflect what we are measuring right now. So first of all, the market's already starting to recover a little bit, so it doesn't seem to be that severe yet. None of this should be very unexpected. I mean, we all knew that there's a lot of noise coming with the Trump administration, and it's probably just the start of it. But then let's look at our indicators and see what they are telling us. First of all, they're telling us that implied volatility, even on the currency, remains low. The pricing for crash protection on the rand remains low. So we don't see that as a positive. We actually see that as a negative, because it means that there's definitely room that if this rumor gets more severe, or if those news is followed through, there's not a lot of negativity in the price yet in terms of market panic. So that means, yes, certainly there can be a bigger reaction if there's a follow-up from Trump, if he comes out and says he's serious about following through, if that investigation, which he has now announced, comes with a negative outcome, definitely the room for a bigger sell-off, because we can see there's no panic yet. That's as simple as that, and we can systematically measure it. That's a beautiful example, actually, how to turn qualitative data into quantitative decision-making tools. What I will say, though, is that the more important view on the asset classes like SA bonds, SA equities, and the rand are informed through our valuation set, right? And if we just look, and we spoke about this in this webinar at length, that our asset classes are priced in total to a very, very, very cheap level, right? So we're already earning very, very high CPI plus returns in our bond market, our income market, our currency is underpriced, our equity market is underpriced. So with that stance is quite clear, and that's exactly what we can systematically derive. Sorry, I'm going quite long on this question. I guess it's the one of the morning.
Yeah.
yes, no full panic yet. With that, definitely room for a bigger sell-off, but then cut through the nose, look long-term, and then definitely there will be recovery. And there will be more of this through the, I guess, unfortunately, the next 4 years.
Okay, Conway, this one seems like it's for you. Regarding infrastructure, what is your involvement, if any, on water sustainability?
So, good morning, everyone. Just 2 points on it. The first one is that we are considering through our infrastructure debt funds various deals related to water sustainability and water infrastructure. I think there's a lot of focus on the provision of clean drinking water, but we look through that to, for example, where there are mines that actually need water treatment. So again, lots of opportunities abound in terms of both drinking water, potable water, and then also the treatment of, I suppose, mine AMD. But if you're just moving along to the larger ESG sort of consideration, since we started our ESG journey, included sustainability across the E, S, and G. There's always been a big focus on the environment with relating to climate change, with relating to renewable energy and the likes. But importantly, in our 67 factor model, there are various pillars that include water sustainability, whether it is that a company has a sustainable practice relating to water usage, whether it is recycling of water and the likes. So because we fully integrate ESG into our full decision-making process, into our default analytics, it's already there and it's always been there. So the 2 points simply is that we are considering various deals that actually would help the actual ecosystem, the infrastructure ecosystem. Then also we're already looking at how business integrates sustainable practices into their mechanics that we can assess, and then we can actually get a default probability based on that.
Then, Dusty, I think this one for you. The multi-asset income category is diverse with many approaches and different risks. How do you differentiate yourself in this category?
Sure, Kelly, I guess that links to our income provider strategy. I think it's very well differentiated in the category, which you rightfully say, or that question rightfully suggests, is very diverse. So I guess first starting point is we focus heavily on asset allocation. We don't focus on security selection. We strong believers that asset allocation is a more dominant factor. So we use all the asset classes, be it prefs, property, bonds, income assets, currency exposures, credit. Conway mentioned alternatives. All of that we use and we asset allocate, and that's how we derive our returns. The second point, and I think once again applicable this morning, we use our systematic approach. So we run the strategy quite systematically, which gives us an edge, especially markets become volatile like today, and helps us to cut through the noise and eliminate our own fears and our own greed and just make sure that we invest in the best possible way. But last but not least, and I think that's always what needs to be said in the context of income provider, that the core differentiator for us is really our risk focus. And I think that's where we first in class, like understanding risks into the detail and always being committed to not losing capital over 3 months rolling. And that's really ingrained in the strategy and the way we think about it. And that's what really enables us to create this, what we sometimes call sleep easy fund, where our clients can really rely on the fact that they will not lose any capital over 3 months rolling. And I guess that's very, very powerful and very well differentiated, because even in a category as conservative income category, it's not a given. Many strategies in there are actually quite risky, and that doesn't apply to ours.
If we can please just take one more. This was very kind of a client, but your equity strategies had an amazing year, all of them beating benchmarks again this year. Where does this leave our alpha expectations for portable alpha strategies, given that this has worked out so well for you?
Yeah, thanks for those warm words, first of all, to the audience. What I will say is, yeah, it's a behavioral bias to think that we had 2 good alpha years, now the next one must be bad. That's really not how we think. We should eliminate those biases, as I mentioned earlier. But what we really measure is, like in our portable alpha strategy, we can measure exactly what the expected alpha is. And I don't want to make clear promises here how much we're going to earn, because there's a volatile path around that, but we can measure that the expected alpha is roughly in the vicinity of 1% again for this year. So we should definitely get another good year. It will not be a straight line. There will be volatility around it, as there always is, but that in itself makes us very, very optimistic. So yeah, and definitely high positive alpha expectations again. And then also I want to say, with that inflation shock post-COVID, which we had in 2021, 2022, when US inflation spiked to 9.1 and the Fed embarked on the steepest hiking cycle in 30 years' time, I guess that was the absolutely shock moment and the hardest test which we could ever put the strategy through. So the mere fact that we emerged stronger out of that, actually finishing even that year with a positive alpha, that gives me confidence. So yes, positive alpha outlook, but what really makes me confident around our portable alpha strategies and mostly core equity is obviously the fact that we stood the test of time and just are able to produce alpha and eliminate the volatility around it quite nicely. So that is quite encouraging.
Okay, thank you so much once again for joining us. We trust that it's been very informative for everyone. If you have any further questions, please feel free to reach out to us, contact our regional business development managers, and we'll be sure to answer those. Otherwise, have a great day further.
Thank you.